Gold and silver, for as long as most of us can remember, they've been treated like financial twins, the go-to assets when you're looking for safety. But what if that whole idea is a fundamental misunderstanding? What if one of them is a shield, while the other is quietly becoming a rocket engine for the future economy? In this explainer, we're going to challenge that old assumption, because understanding the difference could be absolutely critical for your portfolio.
So let's just start with a really direct question. What if the very asset you're holding for safety is also the one holding back your potential for real growth? Now, I know it's an uncomfortable thought, but it's one we have to consider as we look towards 2026, because the relationship between these two metals is changing in a really fundamental way.
It is time we stop seeing gold and silver as the same thing. Their roles are diverging, and fast. So think of it this way. Gold is the protector. It's there to protect the wealth you already have. Silver, on the other hand, is becoming the engine for future growth. Now, those are two completely different jobs, and understanding that distinction is more important now than ever before.
To really grasp the opportunity in silver, we first have to be crystal clear about gold's true role. It's not about growth, it's about survival. You should think of it as your portfolio's financial seatbelt.
Gold's primary purpose is, and has always been, defensive. Its value comes from its unique ability to preserve wealth, to act as insurance during a crisis, and to be a hedge when fear just grips the market. This is why central banks hold it in deep vaults. It doesn't build anything, it just endures. Its job is to be a stable store of value, and in that role, it really is unmatched.
This quote just puts it perfectly. Gold isn't designed to get you from point A to point B in a hurry. It's designed to make sure you survive a crash. As a purely defensive asset, its job is simply to keep you from losing your purchasing power over the long haul.
Okay, so now let's pivot to silver, because this is where the story changes dramatically. While gold is sitting in a vault, silver is out there, an active participant in the modern world. It has this dual identity that makes its investment case fundamentally different. And here we see the key distinction. Sure, like gold, silver has a history as a monetary metal. We all know that. But unlike gold, it is also a critical industrial input and a strategic resource. So while gold really has one primary function, silver has three. And in the economy of 2026, those second two functions are becoming the dominant story.
So why is this distinction so critical right now? Because we are in the middle of several global megatrends, from energy to data to defense, and they are creating a structural demand shock for silver. This isn't some temporary cyclical thing. This is a fundamental economic shift.
That demand really rests on three non-negotiable pillars of the global economy. First, you've got the green energy transition, which needs huge amounts of silver for solar panels. Second, there's the massive build-out of AI and digital infrastructure. We're talking everything from data centers to 5G networks. And third, a significant increase in global defense spending on really sophisticated electronics. All three of these are incredibly silver-intensive.
And it's so important to understand this. This demand isn't for optional consumer gadgets that might slow down in a recession. No. It's for essential, non-negotiable infrastructure. Silver is used because of its physical properties. It is the most conductive and reliable metal for these high-stress applications. This makes the demand structural. It is quite literally being built into the foundation of our future.
So we've established a massive, inelastic demand. But to get the full picture, we have to look at the other side of the equation, supply. And this is where the math for silver truly diverges from gold, creating a really powerful case for scarcity.
This slide shows the stark difference. Gold's supply is stable. Almost every single ounce ever mined is still around and can come back to the market if the price is right.
But silver is consumed. Once it's used in a solar panel or a tiny microchip, it's often gone forever. It's just not economical to recycle it. And that means its above-ground supply is constantly shrinking.
This consumption leads to a persistent structural deficit. For years now, the annual industrial demand for silver has been outstripping new mine production. The gap is being filled by drawing down existing inventories. But those stockpiles aren't bottomless. It's a fundamental economic principle, right? When demand consistently outpaces supply, eventually the price has to react.
So how can we measure this dynamic? Well, there's a simple and really effective tool called the gold-to-silver ratio. It simply tells you how many ounces of silver you need to buy 1 ounce of gold, and it acts as a historical yardstick for their relative value.
And right now, that ratio is at a historical extreme. It's sitting well above its long-term average. What that means is, by this metric, silver is significantly undervalued relative to gold. And historically, when this ratio reverts back towards its average, it signals a period of dramatic outperformance for silver. Now, that's not a prediction, it's just an observation of relative value. Of course, there's a common objection here, and I know what you're thinking. Volatility. Silver's price moves more sharply than gold's for sure, and that can be a little unsettling for investors. So let's just address that concern head on, because it's a valid point that needs to be reframed in the context of risk. We need to make a really crucial distinction here. Volatility is not the same thing as risk. Silver's volatility is the price an investor pays for its higher upside potential. True risk, especially in an inflationary world, isn't a bumpy ride. No, true risk is the silent, permanent loss of your purchasing power by holding assets that just can't keep up. So, when you put all of these pieces together, it becomes pretty clear that a new perspective is required, one that moves beyond just simple safety and towards a clear-eyed strategy for the world that we live in right now. This brings us to the single most important takeaway. Gold preserves wealth. It is the anchor of a portfolio. But silver, driven by its inescapable industrial demand and its constricting supply, is positioned to build wealth. They are not competitors. They are complementary assets with fundamentally different jobs to do. And this leads us to a final, pretty challenging thought for 2026. Perhaps the greatest risk isn't another market collapse. Perhaps the real risk is opportunity cost. That quiet, creeping loss of purchasing power that comes from holding only the defensive asset while the global economy is actively being rebuilt with the other. So I'll leave you with this question to think about. Is your portfolio designed only for the fear of what might go wrong? Or is it also designed for the reality of what is being built right now? The answer to that question could be the key to navigating the years ahead.
If you're serious about building real, durable wealth, not flashy illusions, subscribe to Findolax. This channel isn't motivation, it's math, it's discipline, it's ownership. Don't just watch, execute. Your future balance sheet is watching what you do next.